Hello, class, and welcome to this presentation. My name is Spencer Adamson.
My name's Andy Furrows.
And we're coming to you live from Idaho Falls. The company that we decided to analyze is very well known, but upon looking at it in depth, it contains many mysteries and unknowns. At least they were unknown to me before we did this analysis, and that was one of the fun things about it for me. For instance, this company received more Emmy nominations in 2018 for their original content than any other entertainment production industry. If you haven't guessed, the company of our analysis is Netflix.
Perfect. This presentation is going to begin with a discussion on Netflix, Netflix's business environment, and an analysis on their quality of their presented earnings. And then after, we're going to delve into some relevant ratios and their drivers before finishing with an ROPI forecast and our opinions on Netflix as an investment option.
Let's get to it. The first thing is Netflix's business environment. And we start with some of the key players. Reed Hastings is the founder and CEO of Netflix. He's a fairly high-profile businessman with accomplishments that include the founding of company Pure Software. He's a board member of Facebook, the City Fund. He was also a board member of Microsoft as well from 2007 and 2012. At an employee standpoint, Netflix is very well respected and liked. On www.indeed.com, it contains employee reviews, and Netflix scored 4 out of 5 stars on those reviews. Competitors like Hulu and Roku recorded 4 stars and 3.5 stars respectively. So the employee environment at Netflix is on par or exceeds their competitors. Netflix's main strengths in this sector include being first to market. Netflix is far and away the largest entertainment streaming provider with 130 million memberships. To put that kind of in perspective, Hulu in 2017 stood at around 17 million memberships. So Netflix is the clear market leader. Netflix is relatively inexpensive compared to their competitors as well. Netflix's main weaknesses include reliance on third-party content. Since Netflix does not own the rights to much of their streaming content, they have to buy or rent those rights. So they're actually supporting their competitors in some regard. Netflix has also been plagued until recently from very mediocre reviews of their original content. A major threat that arises because of these two weaknesses is the fact that their content providers could withdraw from Netflix. And if Netflix cannot produce the relevant content that viewers enjoy, this poses a large risk. Large opportunities include improving their original content base and expanding into foreign markets. It's important to know that Netflix seems to have a grasp on these strengths and weaknesses, and just the example of them dominating the Emmy Awards in this current year really shows that Netflix is improving in these areas. That leads us to kind of the financial statements and the ratios that we're going to discuss. Besides the audited financial statements audited by EY, we've kind of gained a level of assurance about a fair presentation of Netflix's financial statements within our analysis. Many investors are concerned about their rate of return, and so a company's earnings are very important. And a way to analyze the earnings that we talked about this semester is the Beneish model. It assesses what we call the quality of earnings. And a higher quality of earnings is attributed to higher sales and lower costs in actuality, where a lower quality of earnings would have some artificial profits that are created by accounting anomalies or tricks such as inflation of inventories or the changing of depreciation or inventory methodology. So this model was created by M. Daniel Beneish and uses the 8 listed financial ratios to identify the likelihood of earnings manipulations. Here are the results of Netflix. So the highlight amounts are the M score, the final score, and the interpretation of this is that a score less than negative 2.22 is good, meaning the probability of earnings manipulation is very low. Historically, Netflix has shown an M score of below negative 2.22, and therefore we're confident that Netflix is not an earnings manipulator. Now, one of the main ratios for earnings that we're going to discuss is the return on equity. Return on equity is a measure of financial performance. It is how efficient a company can be with every dollar that is invested. It is calculated by dividing the net income by the average shareholder's equity. If your attention can turn to the bottom right, you'll see the kind of the accounting equation. And because shareholders' equity is equal to a company's assets minus its debt, return on equity can be thought of as a return on net assets. So another way to see it is how efficient the entity is at generating income with its assets. Netflix's ROE has increased year over year and has really exploded over the course of the past year, increasing by 10%. The reason being that the net profit is nearly exponentially outgrowing equity. Netflix is also becoming more and more efficient. It's maintained its steady revenue growth of around 33% year over year while increasing their operating efficiency. In the past year, they have decreased operating costs as a percentage of gross revenue by nearly 3%. Netflix return on equity sits at around 17.85%. So for every dollar invested, Netflix is generating around 17 cents of net profit. Most analysts consider anything less than 10 cents to be a poor return on equity. Within the movies and entertainment industry, Time Warner is generating an ROE of 17.12%, and the relative peer average is 9.82%. One concern that we did have about Netflix and their ROE is that the ROE could be somewhat inflated because of the debt that Netflix is involved in. As you can see by the graphics on the right, Netflix is overwhelmingly funded by debt and not equity. And if a company is borrowing aggressively, it can increase ROE because equity is equal to assets minus debt. The more debt a company borrows, the lower the equity will fall, basically. And that leads us to a discussion of debt.
Perfect. So we're going to talk a little bit about the demand for credit and the over-reliance on debt. We're going to turn to a few components that are going to help us to evaluate the overall credit risk of Netflix and to form an opinion on the levels and types of debt that they carry. Netflix has a high demand for credit. They're consistently participating in financing activities, and as we can see on the next slide that I'm going to show you, that their cash flows from financing activities, they had a very large inflow of cash over this last year. This was mainly due to the issuance of debt. So as you can see, they've got their proceeds from the issuance of debt of $3.02 billion. They had a little bit of proceeds from the issuance of common stock of $88 million, and net cash flows provided by financing activities was about $3.1 billion. Most of their operations that are financed by debt are used for the purchasing of new streaming content and the development of Netflix originals. It was interesting to note that in the last year, their long-term debt nearly doubled, as well as an increase in liabilities across the board. The supplier of debt seems to be mostly from debt financing from different institutions and senior notes. And as I mentioned before, there was a little bit of common stock that was issued. They have a $500 million line of credit, and as of December 31st, 2017, they were in compliance with all the related covenants. Because of the reliance on debt, they need a good credit rating. And using Moody's and S&P, Moody gave them Netflix a Ba3 and S&P gives them a B+. And these scores put them at the top of their rating class. The next thing that we want to talk about are coverage, liquidity, and solvency ratios. Coverage ratios are used to determine a company's ability to generate profits and cash to cover the fixed charges from debt. The first three ratios are times interest earned, operating cash flows from debt, and free cash flows from debt. They deal with coverage in general, and in general, we want these ratios to be pretty high. These ratios, for the most part, have gone down in the past year, which shows signs of inability to pay back current debt. The next ratios are the current ratio and the quick ratio, and they help us to evaluate liquidity. Liquidity is how much cash a company has and how much they can generate or convert in short notice. Liquidity ratios are also expected to increase year to year. If we look at the current ratio, we can see that it has gone up year to year over the past 3 years, and it's currently at 1.4. And that means that they have more expected cash coming in than they have cash going out. The quick ratio is a derivative of the current ratio, and it dials in even more on the cash that we expect to receive in the near future compared to current liabilities. Next, we're going to look at some solvency ratios, which are the liabilities to equity ratio and the total debt to equity ratio. Solvency helps us to determine a company's ability to meet its long-term debt obligations, including both interest and principal payments. When we analyze these two ratios, the ideal would be to have lower values. Netflix has higher liability to equity ratios compared to other companies in the industry. And that means that they are more reliant on creditor financing than they are on equity financing. These ratios increase over the years. The ratio increase over the years is a sign that the company is becoming less solvent. It seems that Netflix is doing the exact opposite of what the rest of the industry is doing. And across the board of this industry, solvency ratios are going down, but Netflix is doing the opposite. And the same goes for coverage ratios. But Netflix is on par with its liquidity ratios. And despite this, they are not at risk for bankruptcy, as we can see in their Z-score calculations. So the Altman Z-score is a model that helps us to evaluate the company's risk for bankruptcy. Netflix has a Z-score for 2017 of 2.54. Z-scores, they can be interpreted as follows. Less than 1.8, the company is in financial distress and there is high risk for bankruptcy. Between 1.8 and 2.9 is a gray area, and above 3.0 is a healthy company that is at no risk for bankruptcy. And because Netflix is in this gray area, we think that they should be, or this signifies that they should be cautious about any debt that they decide to incur. Because this Z-score being pretty decent, I mean, they're at least not in the bankruptcy zone, we are not too worried about the coverage, liquidity, and solvency ratios being off from the industry. We think that the areas that they could improve on are items that deal with solvency and the amount of overall debt that they incur. They should also try to lower the amount of debt financed by outside sources and try to raise funds through equity owners. But all in all, we think they're still in a pretty good spot.
Great. And speaking of raising funds from equity, the next slide here talks about market capitalization versus the total book value of their equity. So Netflix has a market capitalization of about 83.2 billion. Their total book value of equity is around 3.6 billion. So the market capitalization exceeds the book value by 79.6 billion. This gives Netflix a market to book ratio of about 23.23. This is slightly under the movies and entertainment industry ratio of 25.06, even though that seems a little large. What that means is basically the market capitalization is 23 times larger than the book value of equity. The market to book ratio is used to determine whether or not the stock is overvalued. And that just means, really, in simple terms, that the market capitalization is greater than the book value. Not necessarily a bad case, meaning that it's not worth as much as it says it is. So we can conclude from this that Netflix is an overvalued company.
Perfect. The last thing that we want to discuss a little bit is the ROPI model forecast. An ROPI model is a practical approach to equity valuation by focusing on operating and investing activities. There are many components to an ROPI model, and many are estimates that we have we have to come up with. Some of the more important components are the WACC, the terminal growth, sales growth, net operating profit margin, net operating asset turnover, net operating assets, and net non-operating obligations. The first one we tackled was the growth rate. Looking at the past years, we can see that the growth rate is steadily increasing. Has increased from 30.26% from 2015 to 2016 to 32.41% from 2016 to 2017. That being said, we are going to take a more conservative approach in our assumptions and assume that it goes up by the last year's growth rate plus 0.5% for the first year. After 2018, we expect that the growth rate will decrease. This is because we don't suspect that this growth rate is sustainable too much longer. Netflix continues to revolutionize the entertainment industry and break new ground, but we suspect that the growth rate will start to taper out, being that there are new competitors that are constantly entering into the market. That being said, we project their growth rate to drop by 10% after 2018, and then 3% each year after 2019. We feel that this is a pretty reasonable estimate because this still shows tremendous growth in sales, even with these drastic decreases in growth. In 2021, when we estimated the growth rate to be at 16.91%, it still puts them at a higher than the industry average. Next was the WACC. Looking at different analyst reports, we can see that the weighted average cost of capital of 10% is an appropriate figure to use. WACC is a commonly used figure in analyzing whether certain investments or projects are worthwhile to undertake. In this application, it helps us to determine our discount factor as seen below. Many of the components we have already calculated in past sections of this analysis, and we were able to use those in our ROPI model. We played with some different components of the calculation in attempts to see which components had the largest effect on the overall outcome. We found that adjusting the WACC and the terminal growth rate had by far the biggest impact on the end product. We settled on using a WACC of 10% and a terminal growth rate of 8%. We changed we wanted to kind of play with those numbers and see if we adjusted them up and down, what would happen. So when we changed the WACC to 10.5%, the stock value per share goes down by down to 158.42. When we lowered the WACC to 9.5, the stock value per share went up to $263.25. We then changed the terminal growth rate down, so we went to 7.5%, and that lowered the stock value to $161.45. And then when we increased the terminal growth rate to 8.5, we saw that the stock value per share went up to $258.18. The stock value per share is a fine-tuned number, and we believe that our estimates on the components are reasonable. By completing the ROPI model, we can compare Netflix price per share at the end of 2017 to the calculated price per share. And when compared, we can see that we are very close and that Netflix is performing how we would have expected them to. So next we want to just kind of talk about, Netflix's current status. They had a high in the year of 2018. Their high for their price per share was $418, and that was in July, which was up a ton from 2017's year-end stock price per share of $196 per share. Today, it's trading at about $286, which is still up a ways from where it was at the end of 2017, which is in accordance with our predictions for growth. The market has taken a hit recently, and it has affected all of the tech industries. We have seen some declines in Amazon, Apple, Disney, and a lot of other providers of online streaming content, but analysts are still saying that they're going in the right direction. Looking at some up-to-date ratios from different analysts, they have stayed pretty close to what they were at the end of last year. During the second quarter, they lost market confidence because they did not meet their subscriber growth goals. And in the third quarter, they won the confidence back by adding 6.96 million subscribers, which was significantly more than their goal of 5 million. And analysts are anxious to see what happens in the fourth quarter and to see what it looks like. But overall, the consensus is that they are doing pretty well and they're exceeding the expectations.
And that being said, kind of just going off of, our analysis of the prior year, obviously we're working in 2017. For all those ratios we had discussed, Netflix is either on par with the movies and entertainment industry as a whole, but it vastly outperforms most of its streaming exclusive competitors like Hulu, Roku, and those types of companies. Because of this, we consider Netflix to be a good investment. It's hard to say what exactly a good investment is because it really just depends on your investment goals and your strategies. So I would say that Netflix is a good investment, but the investor needs to be willing to take on some risk. Obviously, as we spoke on Netflix's debt, there's some risk there. But up to this point, Netflix has been able to generate enough revenues and be sufficient enough in its operations to kind of offset those liabilities. And as we saw from the Z-score, they're not in too much danger for bankruptcy right now. So there's a lot of potential for growth. And there's really no indication that this will end. We project that it will continue into the foreseeable future. So go buy some Netflix.
Exactly. Thanks for watching, guys.
Thank you.